We're talking about Canadian tax essentials, aka stuff I think all Canadians should know about their income taxes. So we'll get into it. In the presentation, I'll highlight a few things here. We're going to do a bit of an introduction to the Canadian tax system. So a very general overview of how your taxes work in Canada. And then we'll move into some common income types and how they're taxed. Some are taxed more preferentially than others, and all income is typically good, but we'll get into some details about how those work. And then we'll talk about the flip side a bit, which is tax deductions and tax credits. And they are different, but they do kind of the same thing. They're both going to reduce your taxes. So we'll get into that because that's an important one, figure out how to lower those taxes as you earn more income. And then I'll jump out of the presentation and we're going to go through a bit of to show how to estimate how much tax you'll owe. And it's a really handy tool to use. It's free. You can probably see it up top. It's through Wealth. And I'll show you how that works and how to use it as a tool in your own tax planning. And then I will do a quick demonstration on how to file your taxes. I've also got some free resources that I can share at the end that give you a more in-depth view on how to file your own taxes. And again, we'll use a thing called Wealth Simple Tax. It's another program that's free to use, or you can pay to have somebody help you out with it too. And then we'll have some questions at the end as well. Hold your questions till the end, note them down as you go, and I'm more than happy to chat through those. And then even if we don't have time at the end for questions, I'll provide my email and you can reach out by email as well. In general, this is how your taxes work. And this is a very broad stroke. So we're going to start with your total income. We're going to add up all the income that you make, and that becomes your total income. From there, we're going to reduce that. We're going to subtract any money that you spent on things to lower your income. That's tax deductions. And I'll show you some really common ones in a bit. Fees, moving expenses, things like that. That reduces your taxable income. Total income minus tax deductions equals taxable income. That's the result that you're taxed on. And you apply your applicable tax rates to that to calculate your taxes. And then you subtract tax credits and you arrive at taxes owing. So we're going to come back to this slide a bunch of times. So don't worry too much if it's too fast right now, because we're going to talk through all of these and show how it all works. Types of income tax. We're talking about tax, not income tax. There's federal income tax, and you can probably guess the second one, provincial or territorial income tax. In Canada, there are two types of taxes, and it depends where you live. Everybody's going to have the federal income tax, and then depending where you are, you're going to have different amounts or different tax rates that get applied to your taxable income to calculate it. I'll show you some examples in a second. I think it's interesting. So it is, I'm going to say, yes, it's interesting to see the examples. It's a little bit nerdy, but that's okay. I'm cool with it. So Alberta is one of the lower provincial tax rates. So I want to give a demonstration of how this works. So let's say Cindy lives in Alberta, and you can see she earns $180,000 in employment income. She probably works for Cenovus or I don't know, one of the oil companies is my guess. She's going to pay $56,000 in total tax in the year. And that's a combination of federal income tax and provincial income tax. So have a quick look at that. $35,000 in federal and $16,000 in provincial income tax. She makes $180,000 and pays $56,000 in taxes. If we move over to Ontario, beautiful province, I've lived there for a few years. So let's say I live there and I make $180,000. I don't know what I do to do that, but good for me. Maybe, I don't know, I'm a software developer, let's say, and I'm in Ontario. I make $180,000 and I pay $61,000 in tax. So compare that to 56 in Alberta. That's the big difference is the provincial tax there. So we can see 21,000 in Ontario versus 16,000 in Alberta. So big difference depending on where you live. And Ontario isn't even the highest. I think it's Nova Scotia. If I did this example with Nova Scotia, you'd see an even higher taxable amount. Everyone pays the federal, and then provincial is different, obviously based on what province or territory you're in. And that kind of brings me to the next point of, in Canada, we have a progressive tax system. And you probably heard of it as, you might have heard of it as marginal tax rate, likely heard of it as tax brackets. And so I'll talk a little bit about how that works. So we'll get into the progressive tax system, aka tax brackets. And this is a very fictional example, but it shows how tax brackets work. And tax brackets there's federal tax brackets and provincial or territorial tax brackets. And so what they are is just like buckets or income levels that have a specific tax rate applied to them. And so each bucket or tax bracket has a higher and higher tax rate that's applied, but the tax rate is only applied to the income within the bracket. So if I earned $0 to $20,000 and that's all I earned in a year, in this fictional example, I would pay $0 in tax because my tax rate is 0 on that first $20,000. If I earned $40,000 in income, I would still pay 0 on the first $20,000. And then again, this fictional example, my tax bracket is a 10% tax bracket between 20 and 40. So I'm only going to pay $2,000 on that income there. And so if somebody earns $120,000 in income, they're going to pay $0 on the first 20, $2,000 on the next 20, $4,000, $6,000, $8,000. As you can see, the tax rates go up based on the tax brackets. As you earn more income, you're in a higher tax bracket. And again, probably the fifth time I've said this is fictional. Tax brackets are a lot crazier. It's $0 to $12,392 and you pay 0%, and they go up, and there's a lot of them. That's why I did the fictional version. And oh yeah, there's our totals there, 120 in income and 30,000 in tax based on all of those tax brackets. And there's a very common misconception that I hear a lot, and that's that oh no, I don't want to earn more income because it's going to put me in a higher tax bracket. And so you do hear people saying that, but it's not quite the right idea, because they're thinking about it as if the higher tax bracket gets applied to all of your income. And so this is how they would be thinking of it, in that as soon as you hit 100 in this higher tax bracket, the 50% tax rate gets applied to all of your income and you'd end up paying 60,000, but that's not right. It's that first example where you're paying 0%, 10, 20, 30, 40, 50, again, as the fictional example. So the kind of point of that is that it's almost always better to earn more income. It's that common misconception that, no, I don't want to be in a higher tax bracket. And typically more income is better. There are a few pretty rare circumstances where that's why I say almost always better to earn more income. And they would be things like, for a pensioner, they sometimes, if they earn more income apart from that, they might have some of their old age security amounts clawed back so they don't get that income. So that's maybe some few examples where if you earn more income, it stops you from qualifying for a program or earning income. So most of the time, almost always better to earn more income. Don't say that being in a higher tax bracket is bad. It's typically good to earn more income. That's the point of that one. And next I'll move on to tax deadlines. And this is pretty straightforward. There are two specific personal tax deadlines. The one is if you're not self-employed. So if you just have a job or if you earn a pension income, the key is just not self-employed. Your tax return is due April 30th and your taxes owing, the balance is due April 30th. So both of them are due April 30th. If April 30th was on a weekend or a holiday or something, it would be the next day. April 30th is on a Tuesday this year. So they're due April 30th. If you're self-employed, meaning like you have business income or self-employment income, your tax return is due June 15th, and that's your return. But weirdly, your tax balance owing is still due April 30th. I always recommend, if possible, if you're self-employed or if you're not self-employed, file your taxes and pay any amounts owing by April 30th. In this case, if you are self-employed and you just can't quite get all your information together to file your return by June 15th, you can estimate your taxes and pay the estimated amount by April 30th, and that's better than not paying anything. And then you can file by June 15th to avoid penalties. And I will show you how to estimate taxes in a bit, but these are the two important ones to remember, especially coming up in the next month. If you haven't filed your taxes yet, I have definitely not. So I'm going to do those in April, and I'm going to help my dad with his in April as well. So again, coming back to this one, total income minus your deductions equals taxable income. Multiply that by your applicable tax rates, because there's multiple tax rates in whatever bracket and province you're in, and then subtract your tax credits equals your taxes owing. So that's generally how your taxes work. And so we're going to start up at the top a little bit in more detail. Again, we've talked about tax rates. We're going to talk about different types of income. And these are just some common ones that you see a lot, and they are taxed differently a lot of the time. So employment income is pretty straightforward. I'll go over that. We'll talk about investment income and some common types of investment income and how they're taxed. Business or self-employment income and how that's taxed. And then there's other, it's this bucket full of all kinds of different types of income. So I'll touch on those as well. So first up, we have employment income, and here's a T4, and you have a job if you have employment income. In this case, this is Pam, and she works at the Vancouver Dunder Mifflin branch. And so she's got a T4. She's got a job, that's employment income, and she has to pay income tax. And you can see in that second box, box 22, her employer, Dunder Mifflin, withholds income tax from her pay and remits it to the government on Pam's behalf. So on your pay stub, you'll see net pay, and that's because you've had income tax deducted already and remitted for you. And typically, you'll also likely have CPP, Canada Pension Plan, and employment insurance premiums deducted as well. And CPP, you're going to be able to collect when you retire. Employment insurance is there. If you can't work, you can apply for employment insurance benefits. And so those get deducted and remitted by your employer. So you don't typically need to do that if you have a job. So Dunder Mifflin Vancouver is taking care of that for Pam. And how this works is you've already paid this tax, and say Pam earns $58,000 in employment income. Her employer typically is going to deduct the right amount of tax from that income, so that all else being equal, she would not pay any more tax when she files her tax return. Where you can see tax amounts owing as an employee is if you maybe have some other types of income as well, where you're not already remitting tax. You might have a balance owing, or if you have tax deductions and tax credits that reduce your tax, this amount that your employer remitted might be too much. So then you get a refund. So that's how that works when you're employed. You remit the tax throughout the year, and then you either get a refund or you have to pay a little bit extra depending on your other income and your tax deductions and tax credits that apply to you. So we'll talk about those in a bit too. And you get a T4. So you get this thing and it'll show up in either paper in the mail or you get an electronic copy. Next up, we've got investment income. And I'm going to talk about interest income, dividend income, and capital gains. And interest income is really straightforward. You earn interest income on things like high interest savings accounts, guaranteed income certificates, loans to other people even. You get interest. You can earn them on this is my actual bank account. So this is typically a low interest savings account that I had in 2020. There's a whopping 7 cents of interest income in September. That's something to think about this is very little money, but if you had some money sitting in a low interest savings, there are different vehicles that are risk-free that you can put it into that'll earn a little bit higher income. So don't be like Paul, put it in something that's a bit of a higher interest account and you can earn some money on balances there. Dividend income is taxed a little bit differently, and I'll go into this one a bit. So dividend income is earned on when you own shares in either a public company. So let's say you own shares in Shopify and they paid dividends, you could earn dividend income that way. Or if you own shares in a private company like Avalon Academy Inc. or Avalon Accounting Inc., you can pay yourself in dividends. And how they work is that you get an actual amount of dividends. So in this weird example, we have Chinandler Bong, who works at Avalon Accounting apparently, and we paid him $80,000 in dividends. So that's his actual amount of dividends. There's this thing called gross up, which creates taxable income. So you'd see on your T5 this higher amount. And then what happens after that is there is a dividend tax credit. And I'm not going to get into a whole lot of detail, but the idea with this is that dividends are paid from after-tax dollars in a company, meaning the company has already paid tax and they pay out money out of their earnings, after-tax earnings. And so it's already had tax paid on it. So there's this concept of integration where income earned by a corporation and then paid out as dividends to shareholders, the government of Canada wants that to be taxed in total about the same as if this person earned it on their own personally. So dividends are actually in your personal income preferentially treated, meaning you pay less tax on dividend income than if you had employment or interest income. And that's because of this dividend tax credit. And again, it's because some tax has already been paid on the corporate level. So we want to balance it out by reducing your tax on the personal level. So that's all you really need to know. Don't worry if you see this bumped up taxable amount on your T5 for dividends, because you're actually getting a bit of a better treatment of taxes because of a dividend tax credit. So that's kind of the main takeaway I want from there, is that dividends are good when they're taxed personally because you pay a little bit less tax. Capital gains income. So this is profit that you earn when you're selling something. And by something, I mean property is the technical term. And property doesn't necessarily just mean real property. It could be things like shares in a publicly traded company, or it could be gold, or it could be cryptocurrency if you're into that. It could be collector's items even. So let's say you bought, I don't know, some art for $1,980 and there was transaction fees of $20. That was your cost for that art, was $2,000. And then you sold it at a gain of $10,000, at a proceeds of $10,000, you would have this capital gain, meaning your total that you got from it minus what you paid is $8,000, and only half of that is taxable in a capital gain. So it's a taxable capital gain of $4,000. So you get a bit of another preferential treatment on capital gains. And the most common is typically when people invest in the stock market, you're going to have gains and losses, but gains are only taxed at 50% of the gain. And then again, we apply your marginal tax rates to that. So this would get added to the total income, and then tax rates would be applied on that $4,000. Next up, business income. So this is AKA self-employment income. And it's a great one because you get to earn income. So in this case, we're going to call this Pam Beasley again. And she's earned $26,000 in, let's say she sold some art. And so she got $26,000 in self-employment income. She isn't taxed on that $26,000. She actually gets to deduct expenses that were incurred to earn that income. So she had some advertising and office and stationery and supplies and travel expenses. Maybe she gets to deduct those expenses. So we go $26,000 in income minus her $4,700 in expenses equals $21,300. That's her actual amount that gets taxed on it. So the nice thing about business or self-employment income is that you get to deduct a few more things than if you're just employed. So it's a great type of income to have. And if you're interested in starting a business, there are a lot of great perks to running a business and having business income. But one quick note on the flip side though, is that we talked a bit about CPP and EI, and we'll give an example here of employment income versus self-employment income. So total tax on $21,300 in employment income is $2,336. Total tax on self-employment income of the same amount is $3,110. And that's because CPP, typically there is, when you're employed, You have an employee portion that gets deducted off your paycheck and remitted to the government. And that's what we would see here of 1,406. But if you're an employer or if you're self-employed, there's also this other portion that you have to pay. As a self-employed person, you're paying the amount that you would normally pay as an employee and the amount that you would normally pay as an employer. So you're going to have to pay this extra amount. So that's something to watch out for. If you do have self-employment income, even if it's only like $5,000 in self-employment income, you will definitely have to pay some tax on it because there's CPP. And I see that a lot of the time people are surprised by it. And it's just a nature of being the self-employed person. You're the employer and the employee all rolled into one. So you have these extra amounts to pay. And then we got other income, and there's lots of types, and you'll recognize lots of them. Rent income. So if you own property and you receive money from tenant, casual earnings. So if you had odd jobs or casual work like babysitting or yard work, it's like self-employment income, but they just call it casual earnings because maybe you made a few $100 here and there. We've got foreign income. So if you have earnings outside of Canada, including wages or business income or bursaries, things like that, and they're foreign related, that's other income. Speaking of scholarships and bursaries, those count towards other income as well. Pension income. And then a really common one would be something like tips or gratuities. So if you're a server is the most common example and you receive tips, that is definitely income that needs to be reported. It's reported as other income. So like I mentioned, I'm coming back to this one again. We talked about total income, all those income types, and then we're going to get into tax deductions and tax credits next. But total income minus deductions equals taxable income. Multiply it by your tax rates minus your tax credits, and you're going to end up with an amount owing or a refund, depending on how much tax you paid already. Tax deductions and tax credits. This is a very good topic to know about because you can save yourself a bunch of money by making sure that you claim tax credits and tax deductions that are applicable to you. But there is a difference between those two things. So tax deductions reduce your taxable income. So we talked about all your income added up equals your total income. We're going to subtract tax deductions and arrive at taxable income. So it reduces your taxable income. Tax credits reduce your actual income tax. It might still sound confusing, but I'll break it down in an example in the next slide. So tax deductions reduce taxable income. We had total income of 100,000. And then a really common tax deduction is RRSP contributions. I always have trouble saying that. So let's say you contribute $10,000 in RRSP contributions. Your taxable income is $90,000 in this example. So then you multiply by your tax rates. This is a very fictional example again. So let's say that you only had one tax rate and it was 25%. You would have $22,500 in tax payable based on this. Tax credits reduce your income tax. So we've already used our tax deduction up there, less a tax credit. So we have a donation tax credit in this example. We're going to reduce our actual tax owing. So that's the difference. Tax deductions just reduce your income. Tax credits reduce your income tax. That's really all you need to know. You might not even need to know that, but we'll go into some common ones of actual tax deductions that you should be aware of because they're common. So it's a list. We'll call it like David Letterman's top 10 are tax deductions. We've got RSP contributions, really common. So if you contribute to an RSP throughout the year, you can reduce your taxable income. And I also have a free course that you can take that talks a lot more about RPs and TFSAs, and I'll show you that at the end as well. But that's a great one to know about and to use. Childcare expenses, if you have to pay to have children looked after to earn income to go to work, that's a common tax deduction. Union and professional dues, I have dues. My firm pays for them, but if I had to pay for them out of my own pocket, I could deduct those from my income. Union dues typically will just show up on a T4 and they'll automatically get deducted. You'll see them in a box on your T4 and they'll get deducted on your tax return that way. Moving expenses is a very specific scenario. If you move to work or earn income and if you move 40 kilometers closer to your workplace, you can deduct some moving expenses. If you think this is you, just do a quick Google. There's some good resources on it online, but it is a tax deduction as well. Home office expenses, that's another one. Some employers request, and even if you're self-employed, you can deduct home office expenses. So things like your internet and your utilities, a portion of those, all that stuff can be deducted as home office expenses potentially. Student loan interest is a common one too. So if you pay student loans, you'll get a form. This is government student loans. So every year they'll send you a form that tells you how much student loan interest you've paid. So if you do have that, make sure you grab that and deduct it because every little bit helps. Employment expenses. So similar to home office, sometimes you're required to maybe use your car or your cell phone for your employment. There are typically times when you can deduct employment expenses from your income. Carrying charges and interest. This is a funny one. Carrying charges, the most common one that I see is really weird to me is a lockbox. Like people pay for a lockbox to keep their jewelry or something like that at the bank. That's something you can deduct. Other things are like interest on money that you've used to earn income. Tax prep fees sometimes are deductible, things like that. Common deduction, carrying charges, and interest. Capital losses. So we talked about capital gains. This is the flip side. If you bought cryptocurrency at the top and then sold it at the bottom, you'd have a big capital loss and you can deduct that against other capital gains. And then business losses. If you start a business, even if you're just planning on getting a business up and running and you're working on it and you're spending money on a website and things like that, make sure you keep track of those expenses, because even before you have income, you can use that as a business loss and record it, report it, and it reduces your taxable income and reduces your tax. Common tax credits. So on the flip side, we've got personal amount, and that's just something that everybody has, and it's every Canadian gets this tax credit regardless. It's your personal amount. You'll see it on your tax return. There's a spousal amount. So if you're supporting your spouse or common law partner, and if they don't use their own personal amount, that can be transferred to you and you can claim that tax credit on your return. There's an age amount. So it's for seniors over 65. It allows them a little bit more tax credit to reduce their taxes payable. Medical expenses are actually a tax credit. So if you have a lot of out-of-pocket medical expenses that aren't covered by a medical plan, you can add those up and claim them as a tax credit. Charitable donations, make sure it's a registered charity. You can Google, find registered charities, and there's a CRA site that you can type in your charity name and find out for sure if it's a registered charity. Unfortunately, things like GoFundMe aren't registered charities typically, so those don't typically count as tax credits. Or if you do claim them, they might be disallowed if CRA ever reviewed your tax return. Disability tax credit, so those with severe or prolonged impairments can qualify for this additional tax credit. There's a caregiver amount, so this is for those who are caring for a dependent with an impairment. You get tax credit for that. Education credits, so that's like tuition fees, textbook amounts for qualifying post-secondary education. You can get tax credits for those. Home buyers amount. It's a first-time home buyers can reduce their taxes payable by claiming the home buyers amount. And lastly, not that common, but I have seen it once, the digital news subscription tax credit. It's fairly new. So if you subscribe to like the Globe and Mail or something like that online, you get a small amount of a tax credit, up to about $500, I think it is, on digital news subscriptions. Total income minus tax deductions equals taxable income. Multiply it by your tax rate equals amount owing. And then you subtract tax credits and you get taxes owing. So that's how your taxes work in Canada. And next I'll talk about how to estimate your taxes. And this is a really handy tool. So if you want to scan the QR code or type it in or just Google Wealthsimple Tax Calculator, it will take you to this website here, and it is the Wealthsimple Tax Calculator. And I love using this for my clients. I like using it on my own or just to explain different things. What you do is you just fill in the fields. Choose your province. I live in British Columbia, so I can have a look and I can see how much tax I would owe if I earn different types of income and different amounts. So let's say I earn $100,000 in employment income. On the right-hand side, you can see CPP, EI, provincial tax, and federal tax. I'm going to owe $25,000 in tax. My average tax rate of all those tax rates combined is 25%. My marginal tax rate, meaning the incremental tax on the next dollar of income. So right now I'm in a 31% tax bracket. If I earned $150,000, I'd be in a 41% tax bracket there. So that's a real example of how the tax brackets work. And what I love about this is you can put in your income. Let's see how much income tax I've paid already. So let's say that my employer withheld enough tax so that everything was perfect. I wouldn't owe anything else. So let's say I got 9/7. So no, let's do 20,400. So my employer withheld $20,400 of tax. I'm getting an estimated refund of $181. And I want to figure out how much RRSP contributions I should contribute. You can do some planning and figure it out by entering them in here. Let's say, what would happen if I contributed $5,000 to my RP? I would save $1,550 in tax right away by doing that. And I would have an estimated refund of $1,731. So this is a really handy tool to use to play around with, just to make sure you're not caught off guard by taxes owing. You can enter all those different types of income that we talked about: dividends, capital gains, self-employment income. I'll do a quick example of that self-employment income because it's interesting to me. Let's say you even earned only $5,000 of self-employment income. You still have some CPP to pay, even though there's no tax owing on that small amount of income. There's still going to be a little bit of a balance owing because you've got those two things to cover. So have a look around at that whenever you want. It's free. It's great to use. I'm not sponsored by Wealthsimple or anything like that, but they just have a good tool to use, and I come back to it a lot. And speaking of Wealthsimple tools, we're going to go to Wealthsimple Tax to show how to file your taxes. And I'm not going to go into a whole lot of detail, but I will take you through what the process looks like and give you some tips on how to make it work well. Google Wealthsimple Tax, copying, I guess you can't copy that, but you can scan the QR code if you want, and it will take you to Wealthsimple Tax. But you do have to sign in. I have a Wealthsimple account, and that's free to have. Sorry, I wanted to start over. Anyway, what you've missed is I chose the year 2023 after I signed in. That's where we're at now. So the actual tax return has started, and it's going to ask us some questions. So I'll put my name, and it's going to ask you if you want support from a tax expert. This is a service that they say you can have it pay for. I'm going to say no. I feel like I am that tax expert. So I'll say, no, I don't need support. And I'll click next. And then you can either pay $0 to file your tax return, which is wonderful if you know how to do it and it's not that hard, or you can have some extra support, or you can have support and a consultation. And I feel like the prices are quite reasonable, but this is the best price. And you can file 2 tax returns. There's no limit on like the types of returns you can file. We'll choose basic and we'll go from there. Enter your birth date. That's not my birthday, but it's close. Enter your province or territory that you live in and enter your marital status. I'm married, but I'm not going to show that one because then it's going to ask you a bunch of questions about your spouse. If you are married or common law partner, it's handy to use that because typically you want to file your returns together because like I talked about a minute ago, if you are supporting your spouse, say your spouse doesn't earn income, you can transfer their tax credit over to you. Definitely a good idea to file together because it's beneficial for one or even both of you to do. In this case, I'm going to pretend I'm single. This is 25 years ago and I'm filing a tax return. So this is a very important step that you don't need to have, but I feel like if you don't have a CRA My Account, please get one. It's so handy. It makes tax filing easier. It makes communicating with the CRA easier. In the free course that I'll show you afterwards, there's a step-by-step guide on how to get set up with one. It's your online portal to your tax information. And it also allows you to connect tax prep software with your tax info. So we could avoid a whole bunch of manual data entry by connecting it. And it just imports all the data and you won't make as many errors and you'll get things that you didn't remember you had. You will miss things. So I definitely recommend registering for a CRA My Account if you don't have one. And it's pretty straightforward. You need your social insurance number, you need your birth date and postal code, and you should have your previous year's tax return because it's going to ask you for numbers on there to prove you are who you say you are. Go in, register, and you can log in and view all of your tax info, and even better, import it into your tax prep software so that you don't have to type as much and you don't make mistakes. So I skipped that step because I'm not actually going to import my own tax info in here. I'm going to set up my return. And this is a wizard, basically, I would call it. It's going to ask me a whole bunch of questions. It's a questionnaire, and it's going to help me make sure that I report all my income and claim all my deductions and get all the tax credits that are available. You can skip this step if you really want, but I recommend going through it. It really doesn't take that long. It's going to say, which tax slips do you have? So you just click them. Employment income. Let's say we also have investment income. These are really common ones, but I don't have those. Statement of securities transactions would be if you sold a bunch of investments throughout the year, you might have those, but I'll stick with T4 and T5 because those are the most common. If you do connect your CRA My Account, it's just going to import these automatically. So you won't even need to worry about this. It's going to ask you some more things. So what other types of income did you have? Let's say we had capital gains. We could have rental income. We could have business or self-employment income. I'll demonstrate a couple of them. Rental and business income is very similar in how they get reported. So we've added those to our return. And then it's going to ask you your status. So I was employed. And in this case, let's say I had a business. If you're a student, it'll make sure it prompts you for this tuition tax credits. If you're retired, it's going to make sure you report your CPP, your pension, if you have that. If you're unemployed, it might ask you for T4E, which is employment insurance. It's just a smart way to go about making sure you report all your income and claim your deductions. More questions. Do you have children or dependents? Did you own a home? Did you have medical? Did you make donations? This is going to help you claim those deductions and credits. And then it's going to say, hey, based on what you said, we found 9 things you might want to add. So yes, you had employment expenses could be one. You donated to a charity. You had medical expenses. You are the lower income, or you have low income and you're employed. You can claim this Canada Workers Benefit. You donated to a political party. You can claim a tax credit for that. Or if you had RRSP contributions or home buyers plan or lifelong learning, these are different things about RRSP, but we'll just say that we had RSP contributions. Or if you had digital news subscription. So let's say I had Globe and Mail subscription. And then it's going to put it all together. And from here, it's all just data entry. So I'm not going to make you watch me type a bunch of stuff. Enter your social insurance number, choose a language. This is not for, I'm going to make sure that says no, this is not for a deceased person. And then it's going to ask you for I always say Netflix. It's not going to ask you for your Netflix. It's going to ask you for your net file access code. And it's not necessary, but it is helpful to have this. And so it's on a notice of assessment. You get that after you file your taxes. And what it does is it just helps you speak to the CRA better. If you do have it, type in your Netflix username and password. No, type in your net file access code there. Enter your mailing address, home and telephone number, answer the questions. Make sure that you include if you were a Canadian resident. And the nice thing is it's got these tool tips. There's a question mark you can click and highlight, or there's I've closed it. The description from CRA on everything that's going to help you understand things. This is why I love this software, is that it's just, oh shoot, I don't know what resident means. Click it and it'll teach you. Enter your province or territory that you lived in at the end of the last year. Did it change? What date did it change? Is your home address the same as your mailing? All this stuff is like fairly straightforward. But again, you can always click the tooltip to figure stuff out. Enter whether you're single or married. If you're married, it's going to ask you more questions and ask you for if you want to file your spouse's return. Same with common law. I'm going to just say single in this case. Did your marital status change? Yes. The date of change? No, it doesn't ask you that. Did you have dependents? Yes, it's going to add more forms for you to fill out. And then more general stuff it needs to ask you. Is this your first time filing? Are you a Canadian citizen? Are you registered under the Indian Act is literally what it's called. Did you have specified foreign property? I don't even remember what that is, so I would click that tooltip. So just go through this and answer the questions as best you can. And then a CRA My Account. This is beautiful if you do have it. Like I said, register for online mail. It's great. It'll allow you to get emails from CRA, and then you connect with your CRA My Account and import all your information into your tax return. It makes things so much easier. And lastly, we have to fill out our forms. If you imported your stuff, these should be automatically filled out. Otherwise, these are the forms that the program has provided you based on the questions it asked and the responses to those questions. So if you had more than one T4, add another T4 or delete it. If you had more than one T5, do the same and go through. And if you haven't imported your information, enter your details. Let's say you sold a bunch of crypto for $0.01 and it cost you $10,000. You're going to have a $9,900 loss. All that kind of stuff is just data entry. But I say that 90% of filing your tax return is just collecting all the information and summarizing it so that you can enter it into your tax return. So when you pay an accountant to do your taxes, that's most of it, is doing the work to compile that information and put it together in a simple way. If you're comfortable filing your own taxes, you'll save money, and it is pretty straightforward with things like Simple Tax. And in that free course, I have a more detailed example of me going through a tax return through this as well. But anyway, the rest of it is just data entry, donations and gifts, medical expenses, and digital news. And I want to leave time for questions. Once you're done, you can review and optimize. It will allow you to make sure that it looks right. It's going to flag things that don't look right. It'll give you a summary based on what you put. It's going to tell you if you have a refund or an amount owing. It's going to provide you with whether or not you get a GST, HST credit. And then you can download your tax documents and you can submit them to the government. Check it out. Well, Simple Tax is really handy. And there's the link in the QR code, and Google it. Simple Tax is the easiest way to find it. This is for the free course. I'll show you where it is as well, but if you scan the QR code, it'll take you to the link. Essential tax info that all Canadians should know. So a bit of it's what I covered. A bunch more of it's going to be RSPs, TFSAs in detail, stuff about employment tax, stuff about self-employment taxes. This was a great idea that Bisola had to put this together. And so I've done that, and it's for you guys if you want it. And the other thing, avalonacademy.ca. This is a newish business that I've started. Avalon Accounting helps small business owners, but we can't help everybody. And so we're trying to be able to help more people, small business owners predominantly, but Canadians, taxpayers as well. There's courses for you in there too. So it's avalonacademy.ca, and there are a bunch of different courses. You can have a look. The two free ones are at the bottom if you do want to check those out. Essential Financial Concepts and Essential Canadian Tax Guide. Anything that says essential, for whatever reason I've chosen that word, means it's a free course. avalonacademy.ca. And there's Joe, that's my business partner, and that's me. And I had a lot of fun building this website and company. It's been really interesting. And I would love to answer any questions that you guys have. Oh, there's lots. I love that. Thank you. That's so cool. Sorry, Basil, I think you're muted there.
Oh, I was on mute this whole time. Oh no.
All good.
Thank you very much, Paul. That was an amazing question. Everyone, please let's give Paul a big round of applause. I would have shared my applause, but I gave you the access to be the host.
Oh, yeah.
I'm sure that was a great presentation, Paul. Thank you. So we do have a couple of questions here.
I would love to answer them.
Yes, let's get into them. Yeah, so the first question here, how do I utilize my unused tuition tax credit?
You can, if you have your CRA My Account, connecting it to Wealthsimple or a tax filing software will import it for you. If you're preparing your tax return using Wealthsimple Tax or something like that, you can make sure that you type in your tuition credits. But like I mentioned before, the main thing is just knowing that you have those undeducted tuition tax credits from prior years, and having a CRA My Account or a notice of assessment handy is going to allow you to see those. And then you just enter them into the field in your tax return, and they'll be claimed. And you do want to claim them when you have income, because typically as a student, you're not going to be earning that much, or maybe not any, and those will add up. Step 1, get the information from online or your notice of assessment. Step 2, make sure that whatever tax filing software you have has that field, and just enter the unused amount, and it will claim those for you.
Thank you very much. Friends, we're going to take photos soon, but we still have more questions. Just get ready, get yourself prepared for our group photo with Paul.
I love it.
The next question, is there a form you have to fill for home office expenses when you work from home?
There is. Yeah, there are. The form is called a T2200, and it's called the Declaration of, I just wrote a blog post on it, but yeah, long story short, T2200, you need your employer to fill it out and sign it, and then you just keep it. You don't need to submit it. You just claim your expenses. And then should CRA ever question you, you have this form that says, yeah, my employer required me to use my cell phone or my car or whatever it was.
Okay. Thank you very much for answering that. Next question. Between tax deductions and tax credits, which one reduces your taxes more?
That's a good question. And it's a terrible answer, but it depends. If you earn, because tax deductions reduce your taxable income, if you're at a really high tax bracket, let's say you make $1 million, you would be in this 54% tax bracket. So reducing your taxable income by $1 reduces your tax by 54 cents. But on tax credits, typically $1 of tax credits might be like 15 cents of tax that it reduces. So depending on what income tax bracket you're in is going to have a different effect. The deductions is going to be more when you're in a higher tax bracket and less when you're in a lower tax bracket because it reduces that taxable income. So it depends, and maybe tax deductions by a slight amount.
Okay, thank you very much. That clarifies it. Does co-pay for dental insurance count as medical expense?
So it does what? Yeah.
Co-pay. So when you go to the
Okay.
dentist office and maybe your company pays 90% and you pay extra 10%, does it count as medical expense?
Great question. It has to be out of pocket from you, which just means if that was your example where your company pays 90% of it, you would only get to claim that 10% that came from your actual pocket once you've been reimbursed. Yeah,
So the
need to only
10%
claim.
counts.
Yeah, exactly.
All right, thanks. How long does it take for your tax refund to be deposited in your account?
That is a great question. And it feels like longer and longer every year. But to be honest, if you file it through NetFile, or which is one of those programs like Wealthsimple Tax, it can happen really quickly, especially if you're set up for direct deposit. I think I've seen it in my own account in 5 days. But that being said, if there's a problem with your return, if CRA flags it for any reason, they do what they want. It can take a long time sometimes. So again, the answer is it depends. But let's hope for 5 days. That's what I've seen on the fastest. Yeah.
Thank you very much. I know you mentioned this briefly, but could you please explain the difference between T4 and T4A? I didn't catch that.
Yeah, actually, I don't know that I mentioned T4A very much. T4 is employment income. So that's just comes from having a job. You're technically an employee when you receive that. T4A can be for a number of different things. Most common, maybe the two most common, one's going to be pension income from a T4A, and the other is going to be basically self-employment income. So if you're working as a contractor for somebody, they're technically required to prepare and give you and file a T4A if you earn more than $500. And why I say technically is because in practice, this many people actually do that. When you earn $550, yeah, it's just a different type of income. Nice income refund in 5 days. That's sweet. Yeah, good. Okay. But yes, T4 is employment. T4A is other types of income.
That's a good one. That's a good one too. Do we also need to file our investments and interest income, or does this work automatically?
Good question. It depends. Typically, if you have investment income outside of a registered account, meaning not in an RRSP account, not in a TFSA account, not in a first home savings account, not in a registered education savings plan, whatever provider of that investment is required to issue you a slip, an information slip like a T5 or a T3. And they give that to you and they give that to the CRA. So CRA knows that you've earned that money and you report it based on what's on your slip. Typically, if you earn less than $50 in your bank account, like my 7 cents of an interest income, you're not going to get a slip. You are still supposed to report that. I don't remember 2020 that well, but I hope I reported like 82 cents of interest income just to be like perfectly perfect at it as an accountant. But yeah, you do need to report it. And most of the time you should get a slip from your provider.
So if you did get a slip, when you do the import slip from CRA on Wealthsimple, it would come over, right?
Yeah.
Okay. Awesome.
Great clarification.
That's one of the benefits of doing that then.
Yeah.
For capital gains, is there a form we should have just the way there's a T4 for employment income?
A lot of the time, and I don't know this fully, but because it seems hit and miss, but I would say most of the time, if you're using an investment provider, I guess Wealthsimple would be an example, even things like Scotia, like those things when you buy and sell investments, they'll provide you with a T5008, which reports the proceeds of the sale. It doesn't report the gain. So you need to have the information available to say proceeds minus your cost equals your capital gain. And so you actually have to do the calculations and fill out the field in your tax return based on your information. So typically I just keep a spreadsheet, but I'm going to get a T5008 if I sell an investment, and that's going to tell me my proceeds. I still have to do the calculation in my tax return to show the actual gain because there's a cost that doesn't get reported on the 5008.
Thank you very much. I do confirm that Simple would send you that form because I just got one on my crypto account. So yeah, you get it whenever you make it. All right, next question. I filled the home office expenses without the fee 2,200, and I have now received my tax refund. Do I need to refill my tax now or just download the form and have my company sign it?
Yeah, you don't need to send the form. Just make sure that you do have one and that your company fills it out and signs it, because there's going to be some specific information that they need to include. But you're probably fine. I don't think I've seen it be reviewed in any of the tax returns. It doesn't mean it won't be, but I haven't seen it. But just grab a copy of it from your employer and hang on to it.
Yeah, thank you very much. I like that you mentioned that it's good to have that form handy, just because CRA can come up to how many years can they audit you?
Up to 7.
7 years.
Yeah.
You better keep all your receipts. And do you know if you can use like digital copies of maybe things like this, or does it have to be paper copies?
Definitely digital is okay. And CRA is getting with the times. I recommend I just take a photo of everything and put it on my Google Drive so that it's saved and stored.
That's the same thing I do. I just take a photo of it. I have the date and the name on the receipts, on the
The
description,
name.
just so I can easily search my folder whenever I need
Cool.
to do it. So thank you very much. Another question, the last one actually. Will this, oh, there's one more. From the scenario Bisola gave about dental insurance, that's the insurance situation, do I need to have the receipt for the 10% paid out of pocket?
What I would recommend is you'll probably have your receipt for the full amount and keep that. And then again, this is one that would be pretty rare, but I guess if you have a lot of medical expenses, it's common to have them reviewed. And what you would need to show is the receipt for, let's say it was a $200 fee for your dental thing, and then 180 of it was paid. You need to provide both of those to show that you paid 200 and 180 was paid by your employer or whoever. So the $20 difference was the amount that you claimed. Yeah, keep both of them. Keep all that info.
Okay, thank you very much. That was a good one, because I would have never thought. And I'm glad that you mentioned that the medical expenses count, because all of my receipts for my copay, I never kept them. So now I need to.
Yeah. You're probably safe, but yeah, grab them.
So last question. With a gross gain in what's the best way to determine the exchange rate to Canadian dollar?
When you're looking at gains and losses on sales, you want to just grab the exchange rate for the date of the transactions. So say it was a $100 purchase and the exchange rate was 1.3, you would have a cost of $130 on that day, and that's what you use for the cost. And then if you sold it for $200 and the exchange rate was 1.2, you would have $240 proceeds. Yeah. And so whatever the date of the exchange of the transaction, just Google exchange rate USD CAD on that date and you can use that. And they're always going to be a tiny bit different, but CRA is all about reasonable. And if they ever looked at it, you could just show, yeah, I grabbed this exchange rate and use that for my calculation. Yeah, nice. Bank of Canada. That's the one. Good call.
Yeah, so I usually also get paid sometimes in USD, and these issues happen. So I just use the exchange rates from Bank of Canada for that day.
That's the one.
And get my invoice over. Thank you very much. Are there any more questions? Guys, this is the best time for you to ask your questions now.
I love it. Thank you for your questions.
Ready to answer them. Honestly, this session has been very beneficial for me, and I'm sure the rest of the guests, because we've learned a lot. And there are some new things that I was surprised about. So thank you very much for covering everything in the most important thing. I did put the link in chat to Avalon Accounting, where you can read more about this and also take the free Tax Essential Canadian Guide, the tax course. It's free, so take advantage of it. If you have any question, Paul is happy to answer them. I would send a recap email with the link to the recording to only members of the group. But thank you very much, everyone. Thank you very much, Paul, for taking the time today. All right, please give me your best quotes. One. Three. And I'm going to pick one for my team to show on the ground.
I love it.
Thank you very much, everyone, for attending today's session.
Thank you.
Thank you very much, Paul.
You're welcome. Thank you, everybody. I appreciate you guys. That was really fun.
Yeah, that was fun.
What a good
Thank
group.
you, Paul.
That's a lot. You're welcome. Thank you, Sarah.
Cool. I wanted to say something, just to say thank you to Paul. I feel like this is very fun. Someone has ever really explained the tax process in a way that I can understand. So yeah, thank you very much.
Love that. Thank you.
I'm glad to hear it. I'm glad to hear it. Everyone in the chat is wow, all the files to report. Thank you very much for doing that.
That's so
Send that to recording. Guys, also take advantage of the free course that Paul has provided. I'm very sure that if you gain this much from this session under 1 hour, gain a lot more from the free course. Check that out. Thank you very much. And I'll let you enjoy the rest of your weekend now.